Hey, welcome back. It's JWalter here. I have a very big announcement, and that is that the 30-year fixed rate mortgage in the US on average has reached almost 5% as of today. So I'm going to be breaking this down with you guys and show how this is affecting our housing market and what implications this could have on our housing market. And if you do get any value out of this video, then please hit the like button. I greatly appreciate that. And of course, also consider subscribing as well. This is the Mortgage News Daily, a great website if you want to look at daily average mortgage rates. So right now, this is on the 25th of March. The average 30-year fixed rate mortgage is 4.95%, almost 5%. The reasoning why this is such big news is have a look at this. So over the course of last year, 1 year ago, the average was 3.37%. Now we're at just under 5%. The big news here, though, look at this. So ever since the beginning of March 3rd, the average was 3.9%. So in just under 3 weeks, we went over 1% in the average 30-year fixed rate mortgage. The significance of this is that at 4.95%, that's the highest levels we've had since basically the November 2018. So basically a 4-year high almost. So part of the reason why the mortgage rates have been spiking is because of the yield on the 10-year US Treasury note. The yield on the 10-year US Treasury note is tied more directly to mortgage rates than anything really. So right now, the US Treasury note, the yield on that, I should say, is just under 2.5%. When you look at over year to date, starting at the year in 2022, that yield was 1.6%. So the higher the yield, the chances are you'll have a higher mortgage rate. So yields were about 1.6%. Now we're at just under 2.5%. This is big news because we haven't had rates this high again since November 2018. And look at the trajectory straight up really ever since December of this year. In December, the beginning of December, we were at 3.18%, now just under 5%. This could cause home buyer demand to decrease because as more and more people get priced out of this market because of rising rates, that could impact home sales. This is a report I found from the National Association of Realtors that shows that pending home sales decreased 4.1% in February. In February, we also had rising mortgage rates, but they haven't risen as much as March though. But the rising rates could have impacted home sales. However, there is a other thing associated with this, and that's of course due to low housing inventory. So let me dive into this report here regarding pending home sales decreasing in February. Again, that was just announced today. So according to the National Association of Realtors, the pending home sale index, which is a forward-looking indicator of home sales based on contract signings. Again, a pending home sale is when a home seller accepts an offer from a home buyer. That's a pending home sale, and the National Association of Realtors formulates this report in their pending home sale index. So they have an index for this. Anyways, this index has decreased for now 4 consecutive months. So have a look at this. This is according to the National Association of Realtors. Again, I pulled this from their website. Right now, the index is 104.9. That's a decrease of 4% compared to last month and a decrease of 5.4% compared to February 2021 when the index was just under 111. So the current levels of 104.9, we've had 4 straight decreases, and also this number hasn't been this low in at least the last 12 months. In addition, when we look at the pending home sale index over the course of the past 3 years, the index hasn't been this low either. In 2019, it was 105.8. Then in 2020 and 2021, we were over 110. So the pending home sale index at its lowest levels in at least the last 12 months, and also compared to the last 3 years as well. And by the way, these are seasonally adjusted annual rates. So Lawrence Yun, who's NAR's chief economist, had this to say: pending transactions diminished in February mainly due to a low number of houses for sale. Buyer demand is still intense. We'll have to see if that continues though, because again, this is for February contract signings. We'll have to see what March does, because as you guys saw, mortgage rates has spiked greatly. We'll have to see how this affects home buyer demand. So it's really interesting times we live in right now because we're having mortgage rates spiking greatly. However, we have near record low housing inventory. So in my personal opinion, we can't have a housing market crash unless we have a significant increase in housing inventory. So have a look at this. This is the latest readings we have for housing supply in the US. So right now, according to the National Association of Realtors, of course, this is a Fred graph, but the source here is NAR. Right now, 870,000 houses that are unsold inventory. The National Association of Realtors includes this number. They include houses that are actually for sale, but also pending home sales because they haven't been finalized. The sale has not been finalized yet. So in any case, housing inventory, according to NAR, is 870,000. Compared to 1 year ago, we're at just over 1 million houses for sale. So right now we're at very low levels, levels we haven't seen this low since January 2022. And this is causing further upward pressure on home prices though, but we can't have home prices increase forever. We can't have mortgage rates spiking and home prices spiking as well because we have affordability issues as those increase further, right? So they went on to say, along with climbing home prices, Yoon added that now home buyers must grapple with rising mortgage rates and also noted that shoppers will likely want to lock in before rates increase further. It might be too late for that because rates are at 5%, and that's a big increase compared to last month and also compared to 1 year ago. In regards to home prices, have a look at this. This is the most recent data we have, again, from the National Association of Realtors. As of February 2022, the median sold price was $357,000. As you can see, ever since September, it's been more or less flat, but in February, it has increased. The all-time record highs were set in June of 2021 at $362,900, so we're not too far off from all-time record highs according to the National Association of Realtors. And as they noted, we're having affordability challenges here. So I actually found this report, it was just published on March 15th. It says housing affordability conditions wane in January 2022. Again, this is also according to the National Association of Realtors. This is not sponsored by the National Association of Realtors, but they have a lot of data here I want to share with you guys today. They say compared to 1 year ago, affordability declined in January as the median family income fell by 4.5%. And here's a key stat here. While the monthly mortgage payment increased 27%. The effective 30-year fixed rate mortgage was 3.51% this January. Now we're at just under 5%. Meanwhile, the median existing home price rose almost 16% year over year. So we can't have home prices increase every single year and not have affordability issues, especially if they rise by 16% in 1 year. And here's a graphic depiction of the Housing Affordability Index. So right now we're at 147.1. It has decreased for 1, 2, 3 straight months. We're at levels very, very low, especially compared to January of 2021 when we had 172.5 was a Housing Affordability Index. And by the way, the lower the number here for their index, the least affordable it is. So as this number decreases, housing affordability gets worse and worse. In this report, they went on to say the following: the surge in home prices combined with rising mortgage rates can easily translate to another $200 to $300 in mortgage payments per month, additional mortgage payments, which is a major strain for many families already on tight budgets, especially with inflation. I mean, gas prices right now in Sacramento, for example, are at about $6 per gallon, which is absolutely insane. And Lawrence Yoon forecasts that mortgage rates will be about 4.5% to 5% for the remainder of the year and expects about a 7% reduction in home sales in 2022 compared to 2021. Home prices themselves are still on solid ground. Yes, as we know, that's a lagging indicator though, because when a house actually sells, that's really an indication of what the housing market was when the seller accepted an offer from a home buyer. Typically, that's about 30 days. So when a seller accepts an offer from a home buyer, the house typically sells in about 30 days. So when we look at median sold prices, that's really an indication about what happened in our housing market 1 month ago. So we'll have to see if there's going to be any changes. However, in my opinion, in order to have a decrease in home prices, of course, we need to have housing supply to increase greatly. Home prices themselves are still on solid ground. They may rise around 5% by year's end, and we should see much softer gains in the second half of the year due to rising mortgage rates, in my personal opinion. So comment below with your biggest takeaways from today's video. Also, if you got any value out of this video, then please hit the like button. I greatly appreciate that. And also consider subscribing if you haven't done so already. Hope you have an awesome day. Look forward to seeing you on the next video.